The upside is provided by the fact that nobody cares about gold, that the market share of precious metals as a component in total savings and investment assets in the United States is 0.5%, down from a 4-decade mean of 2%. My thesis to you is that negative real interest rates, debt and deficits, and counterfeiting, let's call it what it is, succeeds in raising demand for gold and precious metals related assets from 0.5% market share to 2%, which means a quadrupling in demand. I think if somebody is relatively patient and forward-thinking, that it's a bulletproof thesis.
Accordingly, investors should make sure to allocate the right portion of their portfolio to gold, being cautious of getting too heavily involved. While the right amount to invest in gold is specific to the individual, most experts recommend limiting the gold portion of your portfolio to a maximum of 10%. RickRule is the CEO of Rule Investment Media LLC, a prominent figure in the financial industry known for his expertise in investment. RickRule gives an optimistic outlook for gold and suggests to allocate around 2% of their portfolios to precious metals. Gold has appreciated in value by about 500% in the past 2 decades. As per Rule, people are becoming more interested in gold because they are losing trust in governments. Since spiking above $1,950 last March, gold prices remain high due to uncertainties in advanced economies, global conflicts, and intensifying trade wars. Meanwhile, RickRule highlights silver billion-ounce annual industrial use as a distinguishing factor from gold. Demand for silver is rising a lot faster than its supply, a trend that's mostly driven by the metal's use in the manufacturing of solar panels. One study forecasts the solar sector alone could exhaust between 85% and 98% of global silver reserves by 2050. Now, we are presenting you a glimpse of RickRule insights from his recent interview with Expat Money. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
On the other side, with regards to precious metals, we are, as an economic whole, coming off probably the most benign 40 years in human existence. Gold does well during periods of fear. And the truth is that we haven't had much to be afraid of for the last 40 years. I'm going to suggest to you that that's led us to be complacent. And complacency itself should be the author of fear. 40 years of declining interest rates is over. 40 years of at least fake globalization, the increase in global trade and economic freedom, is over. 40 years of peace, one could argue, is beginning to be over. And the reassertion of global geopolitical blocs that have conflict with each other, not least of which over resources, is over too. The consequence of that is that people's interest in gold is increasing because people's trust in each other and their governments is decreasing. So we have a circumstance where, for the first time in my career since the 1970s, the narrative around both natural resources as a whole and precious metals too is simultaneously attracting the primary function, I would argue, of gold is to act as a medium of exchange, is simultaneously a store of value, which is the classic definition of money. Gold is unusual, isn't a promise to pay. It's not an IOU, it's payment. It's done. It's not a check that you have to cash. It's not a currency that somebody can produce too much of. And in that sense, it's a unique precious metal. Silver is more volatile than gold. So its utility as a store of value or as a medium of exchange is less. Its very volatility, like as an example, the volatility around Bitcoin, means that somebody who transacts in silver over time, unless their entire life is denominated in silver, doesn't know what they got paid for an item and doesn't know what they charged for an item. Speculators like silver because after the precious metals narrative has been established, silver tends to be more volatile, both to the upside and the downside, but it has less utility to somebody who owns the metal, as I do, for insurance purposes. The nice thing about silver, from an investor's point of view, is that 1 billion ounces a year gets used in various capacities. It goes to what I laughingly refer to as silver heaven. Most of the gold that's ever been mined gets moved from a hole in the ground called a mine to a hole in the ground called a vault. But silver goes away. Right now, the market share of precious metals and precious metals related investments in the United States is 1/2 of 1%, which is to say Americans' holdings of precious metals and precious metals related assets represents one half of 1% of their savings and investment assets. The 40-year or 4-decade mean was 2%. I'm not suggesting that gold will replace the US dollar. I'm suggesting that we're going to have a reversion to mean. I'm not suggesting that investors have 20% of their net worth in gold. But I am suggesting that they'd be silly at this point in time not to have 2.5 or 3%. When you see gold on the cover of Business Week magazine or the New York Times, trim your position a little bit, right? I'm just suggesting that there is an inevitability around a rebound in precious metals and natural resources, that they go from a de minimis part of a portfolio to a representative part of a portfolio. My own suggestion is that solvent investors, particularly solvent investors who don't have other ways to defend themselves in this economy against the diminution of their living standards, need to be as much as 20% involved in natural resources and precious metals, up from representations that right now probably are 3 or 4%.
Regarding his preferences, RickRule favors gold over fiat-denominated debt, deeming it a more secure choice. Ongoing dysfunction in Washington and rising U.S. debt levels could undermine global confidence in the dollar over time. In 1999, gold prices found a bottom at $252.50 per ounce when the UK auctioned half its national reserves. Since then, gold has made higher lows and higher highs, reaching record peaks at $2,072 in 2022 and 2023. RickRule believes that many nations, including China, are turning to gold not out of preference, but as a form of self-defense. Despite the dip, the People's Bank of China released data showing an additional 930,000 troy ounces, or about 29 tons, to its reserves in August. This is the bank's 10th consecutive monthly purchase as China and other countries diversify away from the US dollar. Let's get back to the interview.
Most people don't own, and maybe they don't feel they need to, physical gold. And I believe, for practical purposes, the people need to own physical gold. They need to regard it as insurance. I'm ironically a guy that owns a big shareholding in Sprott Inc. So theoretically, if the gold price goes up, I profit, right? But I still own a lot of physical gold. I own it because I'm 70 years old and it helps me sleep nights. I regard it as insurance. I'm in the odd position of owning a lot of something that I hope doesn't go up in price. I regard gold as liquidity, good liquidity, volatile liquidity to be sure. But when I look at the arithmetic around other forms of liquidity, US dollar denominated debt as an example, I like those less and I like gold more. And I think that people have been schooled by the last 40 years to be complacent with regards to lots of markets, but fiat-denominated debt markets in particular. The truth is that there are groups in the world that have been forced to look at gold. Not because they want to, by the way, but rather because we've weaponized the US dollar. And also because at a very large level, like China, they understand that there are holding costs in US treasuries. Imagine generating a 300 basis point negative rate of return on $2 trillion in US treasuries. I mean, what an ugly piece of arithmetic, particularly an ugly piece of arithmetic when the debtor is using seigniorage to assert his interests over yours on a world stage, weaponizing the SWIFT banking system, which, by the way, the US doesn't own. In the case of Russia, taking $300 billion worth of US treasuries and seizing them. I don't think that you're seeing the Chinese and the Iranians and the Russians and all these people going to gold because they have some fondness for the barbarous relic. I think they're doing it out of self-defense. I think what you hear in the popular press that says that the enemies of the US dollar are in Tehran and Moscow and Beijing is wrong. The enemy of the US dollar is in Washington. Plain and simple. We're forcing those countries to go towards gold. They don't trust each other any more than they trust us, which is to say the Chinese don't really want a bunch of rubles or a bunch of rupiah. So I think they're going to a system where, in terms of an exchange mechanism, that they are going to have to go into a de facto gold settlement system because they don't trust us and they don't trust each other. But the beautiful thing about gold is you don't have to trust anybody. The receipt of payment in gold isn't a promise to pay, it's payment.
Moving forward, gold remains a crucial asset for investors seeking stability and a hedge against economic uncertainties. The precious metal has seen significant appreciation over the past 2 decades, driven by ongoing economic challenges. How do you perceive the future role of gold in the global financial system, especially during geopolitical tensions and economic shifts? Share your thoughts in the comment section below. If you find this video informative, don't forget to show your support towards our channel by giving this video a thumbs up and subscribe to our channel, and turn on notifications to stay informed about our latest videos covering more exciting topics. Thank you for watching.